A year ago, President Obama and House and Senate Democrats promised that increased government control over the economy, that by increasing government control over the economy to an unprecedented degree, the American people could count on many wonderful things to happen. Among their three major agendas was Dodd-Frank. Specifically on Dodd-Frank, they made 5 promises. A year after Dodd-Frank has been passed, this is the 1-year anniversary, we would like to talk about 5 of those promises. The promises are strengthen the economy, end too big to fail, level the playing field between American financial institutions and those overseas, stabilize the housing market, and finally streamline and simplify the regulatory framework. As we reach the anniversary of its enactment, we can now issue a report card and grade the Dodd-Frank Act against these lofty promises. When we look back over the past year, it is clear that Dodd-Frank has failed to live up to any of these promises. The Dodd-Frank Act burdens the private sector with 400 new federal regulations over the next several years. The vast majority of these rules have created an atmosphere of uncertainty in which innovators and job creators and lenders can't put their ideas and capital to work because they don't know the rules with which they must comply. This is not how you simplify and streamline rules. It is how you kill jobs. As our report notes, it is beyond dispute that the burden of these hundreds of new mandates will fall disproportionately on our small financial institutions. Our credit unions and community banks have all said that the cost of compliance with Dodd-Frank is taking enormous resources, money as well as time. Our smaller institutions do not have the luxury that mega banks have with hundreds of employees to analyze and ensure compliance with this blizzard of new regulations and red tape. It is equally undeniable that the cost of compliance will reduce the ability of these smaller institutions to meet the lending needs of families and job creators in their communities. And I think any of you who followed the events from 2008 to date will say that it was not our small town banks and our credit unions that occasioned the calamities that we witnessed in 2008. One small town banker is quoted in our report as saying, and we're going to issue a detailed report, the Dodd-Frank Act will add an additional enormous burden and has added new risks that will inevitably translate into fewer loans to small businesses. Let me close by saying this. Small banks were being audited 2 to 3 times a year on the average by different regulators. What we've basically done is just added double the amount of regulators, regulations, and examinations that our small banks and our credit unions have to go through. And I think anyone that thinks that just putting another 12 or 14 regulators in a small bank is going to lead that bank back to health is kidding themselves. So the first grade we're going to issue is the promise of Dodd-Frank that they would streamline and simplify rules. And for that, I think a grade of, here we go. At least you're paying attention. Great. I think I'm being kind there.
You could get lower than an F.
Have you caught the drift of this press conference yet?